Welcome to the Nonprofit Voice, which is brought to you by Nonprofit Pro, the go-to resource for nonprofit management and strategy. In each episode, we'll sit down with nonprofit executives, consultants, and technology partners to learn more about the latest tactics, strategies, and trends in the nonprofit sector. As always, you can download all Nonprofit Voice episodes on Apple, Google, and Spotify. To be the first to know of new episode releases, follow us on social media and subscribe to our e-newsletter.
All right, welcome back. Mark Becker here. I'm the founding partner of Cathexis Partners, and today we're going to be talking about asset-based giving. And I know very little about this. Learned a lot more about it the other day talking to our guest, Greg, and looking forward to having a conversation with him this afternoon. Greg, you want to go ahead and introduce yourself?
You bet. Thank you, Mark. Great to be with you today. This coming June will mark 45 years that I've been involved in this area that historically has been called planned giving. I started in 1980, was working with a financial services firm that just did what they called charitable tax planning. At the time, the amount you could pass tax-free was $275,000 per
Oof.
person. Today, we're over $28 million. So many Americans had a federal estate tax problem, and that was kind of what we did at that firm. I left the firm after a couple of years because I wanted to be involved directly with nonprofits. Spent 12 years in Dallas, ran a foundation in Dallas, then started a company to serve lots of charities, still focused on the estate type gifts, the gifts coming to a charity when somebody dies. In 2010, during the Great Recession, we shifted gears for a couple of reasons. One, charities were scrambling. They had donors that were really losing their shirts during that economic downturn.
Mm-hmm.
Second, the amount of that exemption, the amount you could pass tax-free had gone from $275,000 to, at that point, over 20 million. So we shifted gears to current gifts, and that's really asset-based giving. We sometimes call it balance sheet philanthropy, but it's really about creating current gifts for charity. That's the tip of the spear.
Mm-hmm.
Will still help somebody on their estate plan. That really is a secondary conversation.
So, can you explain what asset-based giving is and how it's different from traditional cash donations?
Yeah, so the $557 billion given last year, the vast majority of that was people writing a check. That's
Mm-hmm.
traditional philanthropy in America. But the average American has 9% of their net worth in cash. 91% is in stuff. It's in assets. And so we're tapping those assets because there are benefits that we can create for the donor that can either reduce their cost of the gift or allow them to give more than they thought they could. So it's gifts coming from the balance sheet. It could be as simple as public stock. It could be a rental house. It could be a farm. It could be a piece of a family business. We can talk more about that in a minute, but it's those balance sheet gifts rather than checkbook gifts.
Got it. And what are the most common types?
Well, stock would be the most common. Most
Yeah.
of the charities that are on the call here are able to receive gifts of General Motors stock or Microsoft stock or whatever. That's pretty common. You would be surprised at how often a busy donor just kind of forgets about it. They keep writing checks and then they rebalance their portfolio and sell their appreciated stock, recognizing gain when they should have just given that stock.
Right.
So that'd be the most common, Mark. I would say there's $23 trillion north of that number in IRAs and 401ks. That's another common category. The less common would be real estate, ag land,
Mm.
warehouses. I just had a call a couple hours ago with a retired architect selling two of their office buildings. He retired 6 years ago, and now they're getting ready to sell the buildings. And so we're going to help him give a portion, not all, but a portion of those two buildings to charity prior to the sale. So that would be an asset gift.
Nice. And in that example or in the example of the stock, then it sounds like the benefits to the donors are the tax
Yeah.
kind of shelter, right?
Yeah, you get two benefits. If I give cash, I get a deduction. If I give public stock or like this guy, give a building, Now I get two. I avoid the long-term capital gain taxes. So on a $1 million gift in California on a fully depreciated building, that could be $350,000 of savings right there for the donor.
Hmm.
And I still get a fair market value deduction. So $1 million deduction. So I've gotten two significant benefits instead of selling the building and recognizing that tax and giving after-tax cash. That's
Got
that's
it.
the secret sauce that serves the donor as well as the charity.
Right, right. Any other benefits to the nonprofits themselves?
Well, you're tapping a whole new channel of revenue
Right.
because donors just their knee jerk is they think about what can I write a check for? If you
Hmm.
can educate the donor on, well, think about your public stock or think about that rental house that you bought 30 years ago or your vacation home you're not using anymore. It opens up a whole new category for the donor to consider.
Got it. So, what do you suggest nonprofits do to start that conversation with donors about not just pulling out the checkbook? I mean, that's always great, right? But how does that conversation start with the potential donors?
I think the first step would be to educate the staff and board because the charities themselves don't understand this. They tend to think that if I've got a board member or a major donor who owns a $20 million company, I bet they have all this figured out. And
Hmm.
that is not the case. That would be very unusual. That wouldn't be 1 out of 20 times. So they have to understand and embrace the reality that this is a this is an untapped area for them as a charity and even for their donors. Number one. Number two, I would suggest that they use some of the technology that's available to isolate out of a donor base who does this apply to. You don't want to send out a newsletter to 100,000 donors when you only have 2,000 who this conversation applies to. So I know one of the ones
Hmm.
I am the most familiar with is Blackbaud Target Analytics. They can go into a database and identify all of the donors who own multiple pieces of real estate and or closely held stock or what's called Section 144 insider public stock. Now then the charity, step two here would be to build a game plan on how do we communicate with that audience rather than do a newsletter to 100,000 donors when it doesn't apply to any but just 2,000. I can rifle shot the messaging. I can do webinars. I can train my gift officers so that when they're having lunch or playing golf with somebody and the guy says, yeah, none of the kids want the lake house, I guess we're going to sell it. Or I'm dumping that warehouse I loaned for 30. I'm tired of dealing with tenants. I want the alarm bells of that gift officer to go off, come back and say to his boss, this just happened at lunch. What do we do now? Uh,
Right.
because the donor otherwise is going to go ahead and sell it, pay the taxes, and then be generous after the fact.
I love it. That makes a lot of sense. So, what kind of policies do the nonprofits have to consider having in place to start all this?
Well, number one, do we want to receive? Are we sophisticated enough as a charity? There's 1.4 million nonprofits in America. Actually, I think north of that, but not that many are set up to receive closely held stock in a corporation.
Hmm.
There's liability exposure. There's unrelated business taxable income issues they can get into. So that's maybe step one. Certainly the Notre Dames and the Harvards and the Princetons and the big boys, yes, they can. Salvation Army, they can do this. But if you're a local soup kitchen or church, then probably not. And in those cases, I would encourage using a third party. There's a lot of fiduciaries out there, faith based and secular both, who are experienced in doing this, and they can be the middleman for the nonprofit. So they don't have to deal with the legal, um, accounting issues. They can use a third party to do that for them.
Got it. Okay. All right. And And how should nonprofits evaluate whether an asset-based gift is a right fit for them?
Well, it's kind of an extension of the previous question. Certainly, public stock is simply a matter of getting a brokerage account set up. That's
Right.
very basic. Um, Receiving qualified charitable distributions from an IRA is just a paperwork issue, a process issue with your accounting department. So some of these things are very basic. They're still important. Just because they're simple doesn't mean they're not important. Um, I think the next step would be real estate. If there's no debt, if it's a rental property, um, it's a house somebody bought for $100,000 years ago, and now they've owned it for 30 years. Now it's worth 300,000. That's a pretty straightforward gift to receive. If you get into farmland where there could be, buried fuel tanks, now we've got, environmental issues that make it a little bit more important to have these policies that you're talking about set up. And certainly, if we get into closely held stock, that would be where I'd probably draw the line for most nonprofits. That's where I'd bring in the pros, the fiduciaries that can do this on your behalf.
Got it. So it sounds like a lot of this is all about education, right? To make sure the nonprofit staff themselves and the board are all educated on this, and then also making sure that nonprofits help educate their donors. So this whole kind of grease the wheels on this whole process, right?
No, you're right, Mark. And it's counterintuitive. I know I already said this, but it's just counterintuitive that major donor or that board member that's a lawyer, by the way, uh, doesn't already have this done. And so that's a hill to overcome for the leadership of the charity, is to emotionally get past that point. And then the donor themselves, they'll often say to the gift officer, yeah, you know what, I pay $1,000 an hour to my law firm to take care of me. I'm sure I'm in good shape. And I've heard that. I mean, hundreds of times over the last 45 years. And I've got success stories where we're able to overcome that. I had one last summer that I lost the deal. The lawyer won the argument. It was a $180 million sale. And we would have saved this donor about $30 million in taxes
Wow.
if he'd taken our recommendations. And the attorney said to the donor, this is just too complicated. You're going to have plenty of money left over to give away. Let's just get the sale done. Let's get it done. Then you can do whatever giving you want to do. And he won the argument. So that cost that donor $30 million.
Wow.
Yeah, so
Yikes.
it's painful to me because I know what 30 million could have done for this particular charity. I mean, they would not have gotten all of that, but they would have gotten some, and that's a big deal. Even three or
That's
four,
huge.
5 million. Yeah.
And it
So
sounds like a lot of the right people were already around the table in the discussion. So it's just a matter of actually executing, right? Sure, it's not simple, but it's doable.
it's very doable. It's a step-by-step process. With this architect just a couple hours ago, his financial advisor was also on our Zoom call, and she said, "Is this complicated?" I said, "Well, we're going to make it simple, but there are certain steps we have to go through, and so we're
Mhm.
going to make those steps very straightforward. 1, 2, 3, 4. Um, so yes, it's complicated, but we're going to make it easy."
What kind of trends are you seeing in the asset-based giving space?
Well, my favorite researcher today on this topic is Dr. Russell James at Texas Tech University. He has just done a tremendous job at a lot of different levels. Um, and by the way, let me just direct you. He's got a website with a lot of free videos that you can look at. One that I just would start with, he has about an hour-long presentation called "Cash is Not King." And they surveyed 1 million nonprofit tax returns to look at the growth patterns in charities that were doing planned giving, gifts of assets, versus those that weren't. And the difference in their growth for those that were was, I don't remember the numbers, but it was dramatically higher than charities that were just seeking cash. He wrote a book called Inside the Mind of the Bequest Donor, where they tracked neurological synapses, when somebody hears the word will or trust or death, how do they react to that versus if they hear in memory of or other words. So Dr. Russell James has great information, a lot of free information you can go on his website and find. In answer to your question, one of the studies that he did was 10,000 nonprofits, US nonprofits, with aggregate giving of $104 billion a year. So significant amount of money. What they discovered was that donors who give more than $5,000 make up 0.74%, so less than 1% of the donor base, but they give more than 76% of all the money. You think about the old, remember the old Pareto principle of 20% of your effort produces 80% of the results. This is 1% of the donors are producing 80% of the gifts. So that's one trend. And the application there is that a lot of those folks are the ones that have these asset opportunities. They're the business owners, they're the property owners, and they're stroking checks when they've got this 160 acres that they bought for hunting, but now my knees are bad, so I can't hunt anymore, and it's just sitting there. Or I've got this rental house or this vacation house. I mean, those are the donors that we want to educate because, again, it will serve the donor. Mark, it changes the conversation for that major gift officer from, we've got a great mission here, we've got a capital campaign going on, you've been generous, can you do this next year? It changes it from fundraising to serving.
Mm-hmm.
Could we help you save $1 million in taxes? We had a donor of a university in California who was a $5,000 a year donor to this charity, and when they sold their family business, her portion was $48 million. We saved her $13 million in taxes.
Wow.
And she made to that charity, she made an immediate gift after the deal was done of $5 million. So she went from $5,000.
5,000 to 5 million. That's exactly. A couple extra zeros.
It is. And the point is, she felt served. The VP of Advances said, what was your motivation here? She said, I just appreciated the help you guys gave me. So back to Dr. Russell James, that $5,000 donor can begin to feel like an ATM machine. Mm-hmm. You're going back to the same well every time, and thank you for the 25,000 you gave us last year. Could you make it 50,000 this year? Whereas if we can help them give that rental property or that 160 acres, now we're serving them and at the same time maybe creating a larger gift. Another study they did was part of the same one. In 2000, 67% of Americans gave to charity. By 2018, so after the Great Recession, it was down to under 50%. So you have fewer Americans, a lower percentage of folks giving to charity, even though during that same time span, the giving continued to rise. So less money coming from more people, which again underscores this thing that a guy named Oz Guinness called donor fatigue. Just generous people getting worn out. They just get tired. And so this asset-based giving conversation, this balance sheet philanthropy, it truly can change the chemistry, the relationship between the charity, the gift officer, and the donor, from fundraising, can you help us out, to serving them and kind of partnering with them on disinheriting the government, frankly, to get that money to charity instead.
Exactly. I like it. So, kind of full circle, kind of bringing this all together. You mentioned, in a couple different ways, how important it is to really um, do the drill into and do your prospect research and your donor propensity to give and what their asset classes are. And yeah, there's all this technology out there that can do that, right? I mean, there's a lot of publicly available data on if you have over a 40-foot boat, you have to
Right.
register with the Coast Guard, and if you have
Right.
a 3-car garage, that
Right.
kind of thing. So all that data is out there. Then you have new technology like Chariot that's been out for a couple of years for DAF, making DAF donations that much easier. So tech, and then AI and all the possibilities that come with it. Just the technology that can help bring all this together. Anything else happening in that space?
Well, I guess the other tech benefit we've had post COVID is just Zoom and video conferencing.
Mm-hmm.
My first 35 years, even 40 years of doing this, I lived on airplanes. I mean, I'd fly to Chicago to have lunch with somebody because they had one of these conversations. And now, I mean, it is people are comfortable. I had a big ag business sale in California, uh, just a little bit over $80 million. And I never met this guy for the first 8 or 9 months that we were talking. It was all on Zoom. It's him, his tax attorney, and me. So what that does is it expands the bandwidth of your gift officers and your plan giving team. They don't have to be flying all over the country. They can do a lot right from their office. And
Mm-hmm.
so I think that's a huge, huge benefit. There's also things out there. There's a video email that I don't know if you ever have had anybody on talking
Oh
about.
yeah.
Yeah, I think that's another way that you can be high touch without necessarily getting out of your office.
Mm-hmm. Yeah. And just yeah, hearing all this, just changing it, it's still transactional, but it's just adds a whole different color to the transaction, having it be something of substance besides just writing that check. It's a whole
Yeah,
different.
10,000, they tell us 10,000 baby boomers retiring every day. And a lot of those folks, they've got these liquidity events, whether it's as simple as a rental house or a billion-dollar corporation. And that's our audience for this conversation. And so I would
Yeah.
suggest that this is uh, just a magnificent opportunity to serve donors, create the largest gift of their lifetime. So for them, it's a huge benefit, save them taxes, and create these milestone gifts for the charity that they would not have gotten out of the checkbook.
So to wrap up, kind of a two-part question here. What advice do you have for donors that want to, explore donating in this way?
Well, I'll go back to the architect this morning. I mean, this is maybe my fourth conversation with him, and I had to remind him again, don't don't put those buildings, don't list them for sale. Don't get into a binding contract because once they've done that, we can't help them.
Mm.
So I would say to the donors, if you think you're going to sell any appreciated asset, whether it's as simple as a rental house or a big company, anything in the next 36 months, begin to do the analysis now. You don't have to lock anything up, but just do the analysis so you have time to think about it, process it, talk to your advisors, get comfortable so that it's not an 11th hour, a white knuckle landing. We've got to get this done by next week because the buyers are pushing us to sign the contract. So I would just say slow down, hit that pause button, and evaluate your options. You can always take what you decide you want to do, put it on the credenza, and now go ahead and start, hire an investment banker or whatever you're going to do, get it ready to sell, and then we can implement when you've got that buyer who you want to sell to. That's when we can implement. We don't have to implement 3 months or 3 years in advance. We can implement right at the end, but you will have already done your thinking and investigating ahead of time.
Makes sense. It makes sense. And finally, what's the kind of the first step that you would suggest for nonprofits?
I think the first step would be to take advantage of some of those free videos that Dr. Russell James has, because it really will give you a deeper understanding than I can here in a short podcast. That Cash is Not King is a great one, and he has others. Uh, that'll educate you on how does this serve the donor. It truly does. This is not just fluff. It truly serves the donor. And how does this create milestone gifts for us? And then what's the data on that proves how this helps charities raise more money if they can open up this category of asset-based gifts? That's a good simple, basic next step. We do more in-depth webinars for charities if they want to learn more. We can certainly do that. That'd be another step. But I think Dr. Russell James is a good first step.
Yeah, well, when I first started having conversations or thinking about this, I was like, oh, this is going to be chewy. But you made it straightforward. And if I can understand it, I know everybody else listening in can. So, Greg, really appreciate your time today and all your insights. And if anybody has any questions, definitely reach out to Greg and his team. They definitely have the answers. Really appreciate time today, though.
Thank you, Mark. Great to be with you. Have a great day. God bless.
Thanks for listening. Listen to more episodes at nonprofitpro.com as well as on Apple, Google, and Spotify.